Hello everybody and welcome to today's webinar. Today we will talk about the Commodity Channel Index, or the CCI for short. The Commodity Channel Index is a versatile indicator that can be used to identify a new trend or warn of extreme conditions. In general, CCI measures the current price level relative to an average price level over a given period of time. So first of all, let's learn how to set up the indicator and how to insert it. We click on the insert option on our MetaTrader 4. We click on indicators, go to oscillators, and we find the commodity channel index. Now this window has some parameters and level we can set up. On the parameters window, we do not change anything. We just keep it as it is. On the levels, the defaults are 0, 100, and minus 100. We will also add the 220 and minus 220. You will understand soon why. And after we click on the OK, the indicator will be inserted below our chart. Now, CCI is relatively high when prices are far above their average, and CCI is relatively low when prices are far below their average. In this manner, CCI can be used to identify overbought and oversold levels, as you can see on the arrows I draw here. Traditionally, the levels are 100 and minus 100. And as I referred earlier, CCI measures the difference between currency pair's price change and its average price change. High positive readings indicate that prices are well above their average, as you can see here, which is a show of strength. Low negative readings indicate that prices are well below their average, which is a show of weakness. Now, there are three different ways to use the commodity channel index, and I will go one by one. Firstly, when we are having surges above the plus 100 level, this reflects strong price action that can signal the start of an uptrend. Here we have the example. On the chart, you see a movement of around 100 pips. Then we have the opposite example. Plunges below minus 100 reflect weak price action that can signal the start of a downtrend. As we can see in the chart here, a movement of 270 pips, 280 pips almost. Now, secondly, you can look for overbought or oversold conditions that may foreshadow a mean reversion. Bullish and bearish divergences can be used to detect early momentum shifts and anticipate trend reversals. It is important that CCI is an unbound oscillator. Theoretically, there are no upside or downside limits. This makes an overbought or oversold assessment subjective. Now, personally, I use the plus 220 level and the minus 220 level. The plus 220 level as an overbought level, when it plunges below plus 100, it can be a signal for the start of a sell downtrend. As you can see here in the chart, another 120 pip trade. And when we have the opposite, the minus 220 as oversold, an oversold level, when it surges above minus 100, it can signal the start of an uptrend. As you can actually see here, you have an amazing 260 pip trade. Finally, divergences signal a potential reversal point because directional momentum does not confirm price. A bullish divergence occurs when the currency pair price makes a lower low and CCI forms a higher low, which shows less downside momentum. Now, a bullish divergence can be confirmed with a break above 0 in CCI or a resistance break on the price chart. You can see the examples, how it's confirmed, and of course the movement of the market, a 120 pip trade, confirmed by the bullish divergence. Now let's look at the opposite, bearish divergence. A bearish divergence forms when the currency pair's price records a higher high and CCI forms a lower high, which shows less upside momentum. A bearish divergence can be confirmed with a break below 0 in CCI or support break on the price chart. And again, we have a very nice example and the reaction of the market with a almost 300 pip trade. This basically concludes the analysis and explanation about the CCI, the Commodity Channel Index. I hope you guys like it. Looking forward to hearing from you again, and I'll see you at the next webinar. Cheers.